My name is Jack Snyder. I'm the head of U.S. Wealth at Antares Capital. I'm joined today by Steve Rubenstein, Senior Portfolio Manager at Antares. The purpose of our video today and future videos is to educate the advisor community on current dynamics that are impacting the direct lending market. Steve, thank you for joining us.
Thanks for having me today, Jack. Really happy to be here.
Can you describe over the last 24 months some of the market dynamics that are impacting the market and where your team saw relative value during that time?
Let's start mid 2022. We know at that point the Fed prioritized fighting inflation by increasing interest rates, which almost immediately introduced volatility into the market. Specifically in the leveraged finance market, banks stopped underwriting new deals and became more cautious, clearly to protect their own balance sheets, which we thought was the right decision at that time. Because liquid credit was closed to borrowers, private credit became even more compelling to private equity firms and our investors. We were really able to leverage our relationships and our scale to pursue opportunities in the core and upper mid-market, where we were able to capture really attractive spreads at that time. We were not surprised to see syndicated market activity normalize in late 2023. And as a result, really what we're seeing today is that the entire market has seen increased refinance and repricing activity. On a relative basis, the private credit yield premium versus the syndicated market remains near the high end of the historical range. This tells us that borrowers remain willing to pay a premium for the ease of use and certainty that private credit financing solutions provide.
Steve, great comments. It's very important to hear that Antares has the ability to go upmarket when relative value presents itself in the upper middle markets. You and your team today, where are they seeing relative value in the market? And what are some of the characteristics that are very important for direct lenders to have given the current market dynamics?
We continue to see opportunity in the core mid-market. That's where we focused for nearly 30 years at Antares. Let's talk about spreads first. Spreads in the core middle market have held up better given the lower direct level of competition from banks. Absolutely, spreads have compressed, but we've seen them flatten out in the last 3 months. Importantly, for our new investments, we've generally seen lower leverage, attractive loan to values, and private credit documentation that provides strong structural protections. If you factor in fees, current base rates, all-in yields are still above 10%. So our investors are currently receiving highly compelling risk-adjusted returns for first lien debt. Second, we believe debt issuance volume will improve. We view increased activity in the syndicated market favorably, and that, in our view, should help restart sponsor-related M&A. It should improve the supply-demand imbalance and partially alleviate some of the spread compression that we're seeing. We do expect modest improvement in the M&A volume in late 2024, with real material increases in 2025 and 2026. So what's going to drive that? One, there's record levels of PE dry powder. There's a real desire for GPs to try and return capital to their LPs. There's also a tremendously high backlog of M&A transactions that are waiting to go through. And eventually, we're going to start to see the lower base rate, which should help debt burden costs. The economic environment, our view, remains a tailwind for this to occur. We believe the combination of higher yields and solid earnings will be really good for private credit returns and overall credit fundamentals. Jack, finally, you ask about, what do private credit managers need to do to be successful? We think performance dispersion is likely, and in a consistently competitive market, our view is these are the important things for managers. First, scale. Scale provides a competitive edge in terms of deal sourcing and ultimately incumbency to ensure that the manager can deploy in all market environments. Two, originations. Long-term relationships and originations creates the widest funnel possible for new opportunities, so managers can be selective and focus on the most compelling investments. Third, consistent credit discipline. Robust credit underwriting and portfolio monitoring capabilities are going to be key for all private credit managers. And then finally, investor alignment. Antares often holds more of each senior loan on its balance sheet than is held in any single fund. We believe these attributes will likely prove to be critical for creating alpha in an increasingly competitive environment.
Steve, thank you for those thoughtful comments. We look forward to sharing insights from other leaders at Antares Capital on future videos.